Hello, it's Jonathan Wellham of Rocklink Investment Partners, and it's December the 15th, 2014. Now, this will be our last video update for 2014, so I thought it would be a good idea to talk about some of the challenges that we see in 2015, many of those being carried forward from this year, and also some of the opportunities that we can take advantage of in the market. Also, I'm going to talk a little bit about oil, which is on everybody's radar screen now, and certainly one of the major topics of interest given the drop in the oil price recently. So, in terms of the ongoing challenges in the marketplace, these aren't changing as we go into 2015. Number one on the list would be slow economic growth. Whether you're in Canada, United States, which are benefiting from a little bit of positive growth, to Europe, which is seeing virtually no growth, to Japan, that's looking at negative growth because of its demographics and some of the challenges they have there, along with China and India and some of the emerging market countries, which are seeing growth, but growth at a much slower rate than has been traditionally expected in those marketplaces. So, as we look at the 2015 lower economic growth, again, that's going to put pressure on the capital markets. Number two, significant debt. As we've talked about many times before, personal debt, corporate debt, and worst of all, sovereign debt or government debt continues to be way too high. And this, of course, is one of the reasons for slower economic growth. This leads to a third issue, and that's continuing low interest rates. The pressure really in the markets continues to be more deflation than inflation, and therefore the pressure on interest rates to stay low and potentially even drop further continues as we go into 2015. So again, we want to be prepared for that and take advantage of opportunities that can emerge as a result of the interest rate levels. Now, that takes me to the issue of the price of oil. Now, recently, everybody's aware, because if you go to the gas stations, you pump your fuel, you'll realize that prices have not been this low for some time. So far in 2014, the price of oil on a per barrel basis has dropped about 40%. This is really one of the largest drops that we've seen in such a short period of time in recent history. And that in and of itself is going to have different implications in the market, and that we won't talk about in this update, but I'm going to talk about one of the implications for that large drop in a second. Now, over the last 4 years in the United States, where there's been this renaissance of oil production, much of it has been funded by cheap money that has been made available at very low rates as a result of the Federal Reserve, as a result of the central bank's policy of printing money, of keeping interest rates unusually low. And this has really led to a bubble of money, if you will, a lot of money going into the oil and gas sector at incredibly low rates, which has put a lot of money in the hands of businesses that probably are quite high risk, particularly if the price of oil comes down. And so how much money has gone into this sort of high yield, high risk market in the United States in terms of debt? Approximately $550 billion in the last four years has gone into what they call the high yield market. Now recently, with the drop in the price of oil, that high yield market has shut down. The yields, the interest rates that are now being demanded in the market have skyrocketed. And this is putting a major concern or shockwaves, if you will, through the high yield market in the United States. It also is putting a great deal of concern on the banks and different financial institutions that own a lot of these bonds and a lot of this paper. So I have two charts that I'm going to put up that just help illustrate sort of the extreme nature of what's taken place in the high yield market in the United States, especially in the energy sector. So the first chart just looks at the price of stocks in the energy sector and what's happened to the price of stocks over the last half year or so. And you can see that energy stocks have dropped about 25 to 30% with the 40% pullback in the price of oil. But what's even more interesting is if you look at the price of the bonds, which means that interest rates have gone up an awful lot and dropped the price of bonds. The price of bonds, or the price of credit, has actually collapsed by about 60%, which is a massive, massive drop. And this is should be a big concern to investors. And so this is one thing that I wanted to point out in terms of the first chart. The next chart looks at the energy spread, the spread on the bonds above the government bonds. And when you look at the spread, it's going to give you an indication of the amount of risk that's in those bonds. Now, the government bonds, the government yields, if you will, are treated as the sort of risk-free rate of return, or the base level rate of return. And so when you think of the spread, you're thinking, what is the market charging above that base level in order to raise money in those particular bonds? And if you look at the green chart, that's the high yield. It says the high yield energy index. You can see that it's gone straight up over the last couple of months. And what that means is that the market is demanding a massive premium for any kind of bonds in the high yield energy sector. In effect, what it really tells us is that that market has shut down, and that if the price of oil stays where it is today, which is lower than $60, or heaven forbid goes even lower, that many of these companies will start to see that they can't raise the money. They're not earning the profits to pay the interest on their bonds, and they're going to go into default. Now, that can take a number of months. It can take 6 months, 9 months, 12 months. And of course, some businesses are going to be more vulnerable than others. But this is going to have a domino or ricochet effect through the economy. We're going to keep our eyes on it. First of all, make sure we don't have any high yield paper, which we don't. We're not invested in that sector. Make sure we're being very careful about financials that we own, and we're very careful about the banks and the life insurance companies that we own, so they're not sitting on this kind of paper. And then make sure that when we're investing in the oil sector, that we're in the leading companies, the lowest cost producers, and the companies with the best balance sheets. And so the 4 companies that we have dispersed amongst our client accounts, and this will vary by client. We own Suncor, we own some Exxon, we have some BP, and we also have some Canadian Natural Resources. Now, 3 of those companies, Suncor, along with BP and Canadian Natural Resources, they're down about 20-25% with the price drop in oil, and Exxon is only down about 13 or 14%. And so we've been able to miss a significant part of the pullback in the marketplace because we've bought companies that can survive low oil prices. They can buy more reserves at cheaper prices as some of the exploration companies blow up and get taken out of the marketplace. And also they have access to capital because they have strong balance sheets. So we're looking currently at this market where we see low growth next year, a lot of debt, interest rates quite low. And then we look at the oil market where all of a sudden you've had this massive, price war go on. A lot of it initiated by the OPEC countries and their desire to regain market share, put pressure on some of the higher cost producers. And this means that this could go on for a while. How do we turn that into an opportunity? Make sure we buy the companies that will survive, the companies then that can buy up reserves at really cheap prices. And we can come out of this even stronger in terms of our own position. So at Rocklink, we've always been somewhat underweight the oil and gas sector. It's around 6% of our total assets. And we have not taken too much of a drawdown because of the quality of the companies we own. But what we're focusing on over the next 3 months, 6 months, as this sort of bloodletting takes place in the industry, is how can we take advantage of that and really rope into greater positions in this sector, but in the very, very, very best companies, the companies with the greatest franchises, and in particular companies that are vertically integrated so that they make money not only through the development and exploration and selling of fuel, but also through refining the petroleum products, selling the petroleum products at a retail level, and making money in various parts of the chain, if you will, using the petroleum products. So that's an update in terms of the current situation in the market. It's quite fascinating. We don't think this is going to end anytime soon, so we're being very deliberative, very careful about our positions. We have not added to any of them. Some of our newer clients who have larger cash positions will just pick away very, very slowly so that we can come out of this really strong and build significant positions in some of the best energy companies that we can find in the market. So I want to wish all of our clients a Merry Christmas, a Happy Holiday, and also a Happy Hanukkah for those of our clients also that are Jewish in their background. We want everybody to be able to enjoy the holidays, spend time with family and friends, and we look forward to serving you in 2015. And the opportunities that will inevitably come our way because of market volatility and a clear focus on buying great companies in strong industries that are well capitalized and are prepared for the long term. Thank you very much, and have a great vacation season and a wonderful Happy New Year. Bye now.